made this list of what I think are important terms. Here are important terms that you need to know. If you don't know, you need to know. Debit, the left side of a T account. Credit, the right side of a T account. So what normally has a debit balance? Tell me one thing. Assets normally have a debit balance. What normally has a credit balance? And what else? Owner's equity, right, except if you have a loss, right, over time, then that'll bring you to a debit balance. What else do I have here? General ledger. That's an important thing. So general ledger, in a general ledger, will you see all the detail for one account, or will you see lots of different accounts? I think somebody said the right answer. It's data from the journal, right. So, all right, so this is important. Let me make sure I go over this with you guys real quickly here. So what do you think the right answer is? Right, it has all the details from one account. So let me see if any of these were right here. This is always like a challenge. Of course, that's like not going to write well. Let me see. Actually, maybe this writes well. Right, okay. So you make journal entries. Here's the problem with this both being down. I have like that much room to write, so we'll see how this works. So you make a journal entry, right? Let's say the idea that someone comes into a store and buys something, for $100. So you debit cash for $100, you credit some revenue account for $100, right? This is known as a general journal entry, okay? You have cash, you have revenue in the same place. I'm going to show you this in a different way. So we're going to do a couple of transactions here. So what happens next? You pay a bill for $50. You had a bill out, well, let's just say we receive a bill in the mail for $50 for utilities. Okay? So what would be the journal entry for that? Utilities expense. You received the bill, you haven't paid it yet. Accounts payable, right? That's okay. That's okay. That's why we're doing this, right? So utilities expense, debit, credit, accounts payable, $50. Then you pay the bill. Debit AP, credit cash. I heard someone say debit cash. You have to get rid of that AP for $50 and credit cash. Okay, so let's just say that's all the transactions we have in that business. This is all general journal. Okay? Yeah, as they happen, there are general journal entries. And I'm going to talk with you more about general journal and subledgers and all of that. But now I wanted to do something different. Have you guys worked with T accounts before? Yes. Okay. So let's just do this here. So I've used cash, revenue, utilities expense, AP. So I need 4 T accounts. So we have cash, revenue, utilities expense, and accounts payable. So now, let's look at those journal entries like this in T accounts. So first we have revenue we receive revenue for $100. We debit cash for $100. We credit revenue for $100. Next we have utilities expense of $50. We credit accounts payable for $50. So right, everyone with me in what I'm doing here? I'm just putting these journal entries here into these T accounts. There's a reason why I'm doing this. So accounts payable, now we pay it. So we pay the accounts payable, 50, and we credit cash for 50. So what's the ending balance in our cash account? $50 here. What's the ending balance of revenue? 100. What's the ending balance for utilities? 50 for utilities expense. What's the ending balance in AP? 0, right? Okay. This is your general ledger. These are all general ledgers. T accounts are general ledgers. If you make journal entries using T accounts, I can look at my cash general ledger and I can see a transaction for 100, a transaction for 50, and I have an ending balance of $50. Okay? So that's my general journal. This is my general ledger. So you make entries into the general journal. Technically, I'm going to tell you a little more about that. Okay? you post them to your general ledger. Here is where they end up. And you know what? When you make a trial balance, the balance you see in cash is 50 in your trial balance. The balance you see in revenue is 100. The balance you see in your utilities expense is $50. And accounts payable has a zero balance because these general ledgers are what directly would post to your trial balance. These are the trial balance numbers, okay? So when you think T account, think general ledger, okay? When you think T account, think general ledger, okay? Hope that clarifies the ledger versus journal, okay? And if you need a little, like if that even confuses you, if you think of a T upside down, that kind of looks like an L, right? So you could think, if you get confused by that, that's general ledger, right? That's your ledger, okay? Just like little helpful memory tools. Okay, so T accounts, there you go. So I'm a step ahead of myself. So that's a T account. We know what those are. So when you think T account, what are you supposed to think? Ledger, general ledger. Very good. Okay. Journal entry. Where do we make those? General journal, right? Those are our journal entries right here. So journal entries always have to have both what? A debit and a credit, and they have to be equal, right? In total, they have to be equal. Okay? So I'll tell you as a funny thing, when I was looking through problems to do with you guys, the book gives all these things where like the trial balance doesn't balance. And I have a lot of trouble doing those problems because I'll tell you that it's not going to happen, right? It will never happen in the real world because your accounting system won't let it post if it doesn't balance, right? So what's the point of going through a trial balance that doesn't balance? I forgot I'm recording here, but oh well. See what I mean? I don't even know. But you know, just a little thing. We won't talk more about that. Oh goodness. Okay. All right. Well, accrual basis. So when we report according to GAAP, it's on an accrual basis. That means we record revenues when they are earned and expenses when they are incurred. Right? We don't worry about when cash changes hands. Well, we have to record that, of course. But we're worried about when things are earned and when the expenses are incurred. Okay, that's the recording things on the accrual basis. You'll see things like accounts payable, accounts receivable, accrued expenses. These types of accounts on a cash basis you wouldn't see. Okay, because you're not concerned with things that are payable if you haven't paid them yet if you're on a cash basis. Okay? All right, so U.S. GAAP. U.S. GAAP. What does GAAP stand for? Good, right. Good. Generally accepted accounting principles. So in the U.S., that's the rules that we follow. Do you know who makes those rules? The FASB. Actually, not the government, which is really glad you said that. We're going to talk more about that in the next class. You wouldn't have even learned this yet, right? That was just a bonus, right? So the FASB, the Financial Accounting Standards Board, makes our accounting standards. And it's actually the SEC. Congress created the SEC, right, after the Securities and Exchange Act of 1934, and they had the authority to make these accounting standards, but they delegated to the private sector. Okay, so ultimately the FASB makes these rules. The FASB didn't always make these rules. There are predecessors to the FASB that we're going to learn about next week, but the FASB makes these accounting rules. Okay, and they're a board. They take input from the outside. Again, all things we're going to talk about next class, right? But that's where GAAP comes from. Ultimately, not, from the FASB or its predecessors. IFRS. So it seemed like no one calls it IFRS, but you've heard of International Financial Reporting Standards. I call it IFRS. Some people call it IFRS. I like the way IFRS sounds better, so I call it IFRS. So you call it whatever you want. Okay. So International Financial Reporting Standards. These are reporting standards that are being used throughout the world by many countries. So countries, we have our U.S. GAAP. Another country might have its own local GAAP, right? But the thing is, we live in this world right now, we're in this real-time economy where we do business all over the world, right? You can see if you look, they'll do news reports in remote countries and you'll see a McDonald's there or a Coke, someone drinking a Coke, right? businesses don't just do business in one country, they do business all over the world, right? And if each of these countries has its own financial reporting rules, which may significantly differ depending upon many factors, some of them being the political climate in that country, some of it being the enforcement in those countries, some of it being, you know, there's a whole plethora of reasons why financial reporting standards would be different. How are those companies supposed to report, right? That could be very confusing. So there's this initiative. This is one of the reasons I say get the most updated version of the text because it's always changing. So the idea is that GAAP is converging with IFRS, right? So again, the European Union, if you are listed on the stock exchange in Europe, you have to report on IFRS now. Okay? People used to use GAAP or their own local U.S. GAAP or their own local GAAP. Everyone's going to IFRS. The U.S. hasn't gotten there yet. The U.S. is on a road. Has a roadmap to get there, where when I taught this class in a couple of years back, it was, we will be converging with IFRS. Everyone has to learn IFRS because we're going to be on IFRS, and IFRS is very different than US GAAP, so it was almost like you have to know GAAP, but you're going to have to know IFRS because like next week we're going to be switching, you know, that kind of thing. It was like you're going to be on one then the other. I'm not so sure that's what's happening now. So, you know, my sense is more that we're converging. So GAAP is changing and becoming more similar to IFRS, right? So maybe eventually we'll call it IFRS, or maybe we won't, but it'll be just like IFRS, right? And one of the issues too is that people use IFRS, but then they kind of make their own local version of IFRS, which is kind of just like everyone has their own standards anyway, okay? Now the big differences here, I mean, there are many, many differences between GAAP and IFRS. But the overall idea that's different is even though we call these generally accepted accounting principles, they're known to be more rule-based, right? So what happens is, and a really good example would be accounting for leases, which you haven't learned yet, but I'll tell you a little bit about it. And I'll tell you, IFRS is more principles-based. So in GAAP, if you are accounting for, if you're looking at someone who has a lease out there, right? And you know, they have a lease for some equipment. Do you capitalize that lease as something they actually are going to really own? They actually kind of own it, or do you expense it as something that they are just renting over a period of time and you're going to return to them? Well, under GAAP, there's rules, right? They say, well, does the lease go for more than 75% of the life of that asset? Is the fair value of the present value of the future payments greater than 90% of the value of that asset? Is there a bargain purchase option at the end? Can you buy this? Will you be able to buy this asset for $1 at the end of the lease? They have these rules, right? And it's like if you meet any of those, if any of these meet the lease, then it's a capital lease. You have to capitalize it, right? Then you can't expense it. So what can companies do if they don't want to capitalize something? They know the rules. They make them. They go, well, it has to be less than 90% of the present value of the future payments has to be less than 90%. We'll make it 88%, right? Is it more than 75% of the life? Let's make it 70% of the life, right? And so the auditor comes in and says, nope, they don't meet that. They don't meet that. They don't meet that. It's not a capital lease because it doesn't go by the rules. Under IFRS, they would say, nope. Looks like a capital lease, smells like a capital lease, that would be a capital lease, no matter what you are trying to circumvent, right? So there's a principle-based versus rule-based. So that's a very big difference between GAAP and IFRS. Now, some people say that going to IFRS is a problem in itself because if you can use so much judgment, you can't compare financial statements. Everybody makes different judgments, right? And comparability, we're going to learn, is an essential part of the foundation of accounting, is being able to compare companies. So there are pros and cons to each of these, to rule-based versus principles-based. But that's just a little overview, GAAP versus IFRS. And you will be learning more about this. I believe that it's being tested on the CPA exam now, but I'm not telling you take a CPA review class. They'll go over that kind of stuff with you. So I'm going to be touching on IFRS in this class, but I was touching on it more when I've taught it in the past. I'm touching on it a little bit less now because we're refocusing a little bit more on GAAP now, okay, with the idea that it is eventually converging. And I will mention areas where GAAP used to be this way, but now it's this way because it's getting closer to IFRS, okay? Any questions on that? GAAP versus IFRS. Okay. So permanent accounts. We talked about that. All asset, liability, and equity accounts. That's exactly what I was just getting at, right? All of our balance sheet accounts are permanent accounts. That's really important. All of our balance sheet accounts are permanent accounts. So if I have permanent accounts here, what do you think is going to come next? Temporary accounts, which what are we talking about there? Revenues and expenses, which go on the income statement, right? There you go. So where did I say that all of these permanent accounts and temporary accounts ultimately get reported? Once you have a balance on the general ledger, in the individual general ledger, trial balance, right? All of that ultimately gets posted to the trial balance. And what happens once you have a trial balance? What can you make? An income statement, balance sheet, which are all types of financial statements. All types of financial statements. So, again, I mean, just walking you through here, I think, let me just see what I go through here today. I don't remember. I have the adjusting entries. Yeah, okay. So what happens is, that this is a good time for me to mention this. So I just actually very briefly, just kind of impromptu did this, right? This is during the period. You make journal entries for all the transactions that occur in your company. Make journal entries. That's just what happens in companies during any particular period. You make journal entries. And then those journal entries get posted to the ledger, right? And then in total, those numbers at any given time, you can make a trial balance based on what the ledgers are at that time, right? You can make a trial balance, right? So that's where we're at right now. You have entries during the period, they post to the ledger, and you can make a trial balance. So we're making our way through the accounting cycle, right? I said you're going to go through everything you learned in your financial accounting class. So there we are. That's where we're at so far, okay? But I'm just throwing in some other stuff too, right? So it's more than what you did in your last accounting class in 3 hours.